Governance.
Outsourcing. Outsourcing is generally considered to take place in an unassisted market, as shown in Figure 4.2. If a firm's market costs are lower than its related bureaucracy costs, then outsourcing to the free market is the appropriate response, given that appropriate contractual safeguards are present. When investment safeguards are not present, unrelieved hazard, both market and bureaucracy costs must be taken into account in determining whether market failure exists. Contracts, which are by nature incomplete, must be complex and disputes will be handled by the court system, raising market costs to the point where other options must be considered. A hybrid form of governance may be appropriate, or bringing the production of the needed service or product in-house through vertical integration or diversification. 46. Vertical integration. Vertical integration was one of the first applications of TCE, 47 and has been shown to be a robust theory in this regard. The most important reason for a firm to integrate vertically is because the market is uncertain, has too much risk, and is unpredictable. A market with few buyers and sellers, frequent transactions, high asset specificity, as well as the standard issues of bounded rationality and opportunism, may be considered a failed market. Alone, none of these characteristics is of particular concern, however, when many are present the market has failed. When faced with a failed market, the best choice of the firm is to integrate. 48. Figure 4.2. Strategy Structure Performance Model. On the other hand, many firms choose vertical integration when it is not necessary. Vertical integration should be an organization's last choice, not its first, because internal organization always experiences a loss of incentive intensity and added bureaucratic costs as compared with markets and hybrids. If, therefore, there are not compensating gains, bilateral or multilateral adaptability advantages, integration is the source of cost without benefit. Firms that mindlessly integrate weaken themselves in relation to non-integrated rivals. 49. An expedient aid to determining if vertical integration may be appropriate was proposed by Stuckey and White, 50, using transaction frequency and asset specificity, in which they counsel vertical integration only when frequency is high and asset specificity is high, as shown in Figure 4.3. Although vertical integration should be a last resort, many firms ignore the many quasi-integration options available to them. Figure 4.3. Asset specificity and transaction frequency. Quasi-integration. Strategic alliances and other quasi-integration options such as joint ventures, partnerships, long-term contracts, and licensing are more adaptable than vertical integration. Quasi-integration mechanisms, often called hybrid governance, protect against market failures that might otherwise indicate that vertical integration is appropriate, while proving some major benefits. Joint ventures, partnerships, and long-term contracting, for example, allow each firm to keep its own identity, thus avoiding antitrust issues, reduce information impactedness and asymmetries through the sharing of technical or market-specific knowledge, and reduce asset specificity and opportunism through controlled ownership, to name but a few. 51. Thus, when vertical integration seems appropriate, quasi-integration should be considered. However, when protection for innovations, for example, patents, copyrights, trade secrets, is doubtful and complementary assets are required or are highly specific, vertical integration may be the only option. Related diversification. The primary benefit derived from related diversification is that of economies of scope, which arises from synergy, shared resources, and know-how. 52. Given opportunistic behavior, information impactedness, and bounded rationality, The need to share or jointly utilize inputs and the ability to coordinate and exchange synergy in the open market would create contracts that are nearly impossible to create, enforce, and monitor. Thus, in situations where assets are specific, resources are shared or jointly utilized, and knowledge is deep, related diversification would be indicated. In other situations, one must consider both the market and bureaucracy costs associated with a related diversification strategy. Although market costs may be high, internal costs associated with asset specificity, monitoring, and scheduling are not free. If the internal costs related to diversification are lower than the costs of using the open market, or if market failure exists, then diversification is the correct option for the firm. Unrelated diversification. Economies of internal capital markets are the primary benefit of choosing an unrelated diversification strategy. Economies of internal capital markets arise when there is market failure, primarily caused by opportunism and information impactedness. External investors are separated from control and ownership, allowing managers to act in their own interests rather than those of the investors. Therefore, an unrelated diversification strategy gives the firm the opportunity to be an internal investor, applying all of its control and monitoring functions to the capital investment, ensuring efficient use of capital and allocation of resources, and oversight of division to ensure efficiency and reducing slack more effectively than if the divisions were standalone business entities. 53